Welcome back to the deep dive. We've got quite a stack of sources today.
Yeah, a good mix. Money, Bankrate, BitGo, Freeman Law, Arcana Network, even a Reddit thread thrown in.
It's all focused on crypto wallets, which, are pretty fundamental if you're touching digital assets at all.
Absolutely crucial, and misunderstandings here can be, well, costly.
Right. So our mission for this deep dive is really to unpack what these sources tell us.
Yeah.
What are crypto wallets? How do they actually work?
The different kinds?
Yeah, the types, the pros, the cons, and really why the choice you make matters so much for things like security and, importantly, ownership.
That's the core issue, isn't it? Ownership.
Okay, let's unpack this.
So first things first, the big point from pretty much all the sources is that crypto wallets don't actually hold your crypto.
Right, not like cash in your pocket. The crypto itself, it lives on the blockchain, that public ledger.
Exactly. What the wallet holds are the keys, the digital keys.
Think of it like a key ring, or maybe login details for your spot on that ledger.
Yeah, that's a good way to put it. It's the keys that give you access and control.
And the sources break these keys down. There are two main types, right?
Correct. You've got your public key.
That's like your email address. Or maybe your bank account number.
Precisely. It's the address you give out so people can send you crypto. It's derived from your private key, but it's safe for others to see. No problem there.
Okay, but then there's the private key.
Ah, yes. This is the big one, the secret sauce.
This is what proves you own the crypto.
Absolutely. It's a secret string of characters. Think of it like your master password that you use to authorize transactions, to sign off on sending your crypto somewhere else.
So if someone gets this,
they control your crypto. And if you lose it, well, you lose control. It's that critical.
wow. Okay. Now, managing lots of private keys sounds like a headache.
It would be. Which is why we have what the sources call hierarchical deterministic wallets, or HD wallets. They bring in the seed phrase.
The seed phrase, those 12 or 24 random words you get when you set up a wallet.
Exactly those. And the sources are really clear. This isn't just a key. It's like the master key, the one key to rule them all, almost.
How did that work?
Well, through some pretty clever math, cryptography. That single phrase can generate basically all your private keys and public addresses.
For different cryptos, too.
Yeah, for many different cryptocurrencies, now and any you add later, all derived from that one set of words.
So if my phone breaks or my computer dies,
that seed phrase is your backup, your lifeline. You enter it into a new wallet and boom, it regenerates all your keys, finds your assets on the blockchain.
which is why keeping it safe is paramount.
Absolutely essential.
The sources hammer this home. Keep it offline. Don't store it digitally if you could avoid it. Engrave it. Write it down. Hide it.
Because if someone else finds it,
They have everything. And if you lose it and have no other
the
backup,
crypto is just gone. Floating on the blockchain, but inaccessible. Effectively, yes. Gone forever. That old saying, not your keys, not your coins. Many now say, not your seed, not your coins. Because that seed is the root of it all with modern wallets.
okay, that's a really crucial foundation. So beyond the keys, the sources give us two main ways to think about the wallets themselves. The first big split is hot versus cold.
Right, and this is all about internet connection. Simple as that. Hot wallets are online. Cold wallets are offline.
So hot wallets are things like mobile apps, software on my computer, browser extensions.
Yep. MetaMask, Trust Wallet, Exodus, Zengo, those are common examples mentioned. Also, the wallets you use directly on crypto exchange websites, they're always connected.
And the big plus there is convenience.
Definitely convenience. If you're trading a lot or spending crypto often, having it ready to go online is just easier, faster, access from anywhere.
But the downside
Is the flip side of that convenience. Being online makes them more vulnerable.
to what? Hackers, malware.
Exactly. Cyber attacks, phishing scams, trying to trick you into revealing keys, malware on your device, bugs in the wallet software itself, especially web wallets hosted by exchanges, they're a big target.
Okay, so that leads us to cold wallets,
Yeah.
the offline ones.
Right. Designed specifically to keep those precious private keys completely disconnected from the internet.
What forms do these take? I've seen those little USB stick things.
Those are hardware wallets, probably the most common type of cold storage now, like Ledger, Trezor, Tangem. The sources mention those. They look like USB drives, sometimes like little cards or fobs.
Are there other kinds?
Yeah, less common maybe. Paper wallets literally printing out your keys and QR codes. Low tech, but, vulnerable to fire or water damage.
Or just losing the paper.
Exactly. And then there are air-gapped devices. That's more for the super security conscious. A dedicated computer that never touches the internet. You move data via QR codes or USB drives carefully.
Okay. And the big advantage of cold storage is?
Security. Massive security advantage against online threats. If the keys aren't online, remote hackers just can't get to them. It's almost impervious to that kind of attack.
But there must be trade-offs.
Oh, for sure. Convenience is the main one. You need the physical device with you to approve transactions. So not great for quick, frequent trading.
And they cost money, right? Unlike software wallets.
Yep, there's usually an upfront cost, maybe $50, maybe several hundred, depending on the model.
Plus, you could lose the device itself. Or it could get stolen or damaged.
Definitely. Physical risks become the main concern. And crucially, if you lose the device and you don't have your seed phrase backed up properly.
Same problem. Access gone forever.
Precisely. Backup is always key.
Okay, so hot versus cold is about internet connection. But there's another really important way to categorize wallets, which sources like Bankrate and Freeman Law focused on.
Yes, and arguably this one gets even closer to the core issue of control and ownership. It's custodial versus non-custodial wallets.
And this isn't about online, offline. It's about who holds the keys.
Exactly. Who is ultimately in control of the private keys?
So custodial wallets, the name kind of gives it away.
It does. A third party, usually the crypto exchange or platform where you bought the crypto, holds the keys for now. They act as the custodian.
Okay, so what are the advantages there?
Yeah.
Seems easier.
Convenience is the big one. Again, it feels like using any other online financial service. You log in with a password. Buying, selling, trading is often integrated right there.
And you don't have to stress about seed phrases.
Right. The company handles the key management, the backups. If you forget your account password, they usually have a recovery process, just like your bank might. Think of the default wallets on big exchanges like Coinbase or Binance.
But there's always a but.
There's a huge but. And this is where sources like Freeman Law get quite serious. With custodial wallets, you don't have direct control. Meaning you're trusting that third party completely, their security, their systems, their solvency, if they get hacked.
Your funds could be stolen.
Yes. Or if they have technical issues, you might not be able to access your funds when you want to. Or even worse.
This sounds like it's leading somewhere specific.
It is. The sources, particularly Freeman Law and Bankrate, raise a massive red flag. What happens if that custodian, that exchange, goes bankrupt?
Ooh, okay. That's not something you usually worry about with a regular bank thanks to deposit insurance.
Exactly. But crypto held on exchanges is generally not FDIC insured or protected in the same way. This isn't hypothetical either.
You mean like FTX, Celsius, Voyager?
Precisely those examples. When those platforms collapsed and filed for bankruptcy, it triggered a huge legal mess. The question became, are the customer assets their property just held by the platform?
Or are they part of the bankrupt company's assets available to pay off its debts?
And that's the terrifying risk. The sources explain that if the court decides those assets are part of the bankruptcy estate, which is a real danger when the company controls the keys, then your funds get frozen.
Frozen how?
By something called the automatic stay in bankruptcy. It legally stops creditors, including customers, from trying to get their money out.
So you can't withdraw your own crypto?
Nope. And it gets worse. Freeman Law points out that customers in this situation are usually treated as general unsecured creditors.
Meaning?
Meaning you're just one person in a long line of people the company owes money to. You stand behind secured creditors, behind the costs of the bankruptcy process itself.
And what's left for you is?
Likely pennies on the dollar. A tiny fraction of what you deposited. It's a devastating outcome.
That's incredibly risky. Did the companies acknowledge this?
Some did. Freeman Law notes that even Coinbase warned in a 2022 filing that, yes, if they were to go bankrupt, customer assets held in custody could be treated this way. It's a known risk of the custodial model.
Wow, okay. That really highlights the alternative then, non-custodial wallets.
Exactly. These are positioned by sources like Arcana and the Wilson Center as the way to achieve real digital ownership, the original promise of crypto, maybe.
So non-custodial means you hold the keys.
Simple as that. You and only you control the private keys and the seed phrase. The wallet software or hardware is just a tool you use to interact with the blockchain. The control is entirely yours.
And the benefits all stem from that.
Pretty much. Complete control. Access your funds anytime, anywhere, no permission needed. You're not dependent on an exchange's security, their uptime, their rules.
No risk of them freezing your account or stopping withdrawals.
None of that. And beyond just holding, this is your ticket to the wider crypto world.
You mean Web3 DeFi?
Exactly. Sources like Arcana really emphasize this. Non-custodial wallets are essential for interacting directly with decentralized applications, or dApps.
And decentralized finance, DeFi, what does that enable?
Things like lending your crypto out directly to earn interest, borrowing against your crypto, providing liquidity to earn fees, trading on decentralized exchanges or DDEXs, all without a middleman company.
Okay, so real peer-to-peer financial activity.
Yes. Plus other Web3 stuff. Managing your own digital identity, voting in decentralized governance systems for protocols you use, engaging fully with NFTs, buying, selling, even minting them.
I think one source mentioned tracking fine art with NFTs.
Yeah, the Wilson Center piece touched on potential use cases like that. For creators, too, it means direct connections, direct payments, maybe programmable royalties built into NFTs.
Interesting. Any other benefits mentioned?
Some sources pointed to potential financial inclusion, maybe using your on-chain transaction history as a kind of credit score,
Yeah.
opening doors for the unbanked.
And resilience.
Yeah, the idea that in a traditional financial crisis, like with banks failing or imposing withdrawal limits, people with self-custody retain full access to their digital assets. They're not dependent on those potentially unstable institutions.
Plus, often no KYC, right? More privacy.
Often, yes, for many non-custodial interactions. In true peer-to-peer sense, you can also combine it with cold storage for top-tier security. They're generally quick to set up, and you can easily have multiple wallets to diversify.
Okay, that sounds like a lot of advantages. Powerful stuff.
Yeah.
But there has to be a catch. The responsibility side.
Absolutely. The cons are basically the mirror image of the pros. That total control means total responsibility.
Starting with securing those keys.
That's the biggest one. If you lose your seed phrase or private keys, or if they get stolen because you didn't secure them well enough,
It's game over. No customer support line to call.
pretty much. Access is likely gone forever. That estimate of potentially $256 billion in lost Bitcoin due to lost keys, it really drives home how serious this is.
Okay. What else? Is it harder to use?
Generally, yes. It requires more technical understanding. Buying, selling, interacting with dApps, managing transaction fees. It's usually more complex than clicking buttons on a polished exchange interface.
And you're navigating the Wild West a bit more. Scams.
Definitely. You have to be much more vigilant. Phishing attacks, malicious websites trying to get you to connect your wallet, dodgy smart contracts, outright scam projects. There's no intermediary filtering things for you.
There was also mention of blockchain specifics being complex.
Right. Things like understanding gas fees, the cost of transactions, which can vary wildly, knowing the difference between networks like Ethereum versus Bitcoin or Solana.
And moving assets between chains.
Yeah.
Bridging.
Yeah, bridging assets from one blockchain to another can be quite complicated and carries its own risks. It's not always straightforward and requires careful attention.
So putting it all together, the choice isn't obvious.
Not at all. The sources suggest it's very personal. Depends on what you're doing, how much you have, how comfortable you are with the tech, and your risk tolerance.
Frequent trader maybe accepts hot wallet risk for speed. Long-term holder with large amounts definitely leans cold and non-custodial.
That's the general idea. Convenience often points custodial, but control, security, and access to DeFi Web 3 demand non-custodial. Many people end up using both maybe a hot wallet for small, active amounts and cold storage for the main stash.
Are things getting any easier on the non-custodial side? The sources mentioned innovations.
Yeah, there's definitely work being done. Things like social recovery are interesting ways to potentially regain access without relying solely on that one seed phrase, maybe involving trusted friends or other devices.
What about account abstraction? That sounds complex.
It is, but the goal is simplification for the user, making wallets smarter, basically. Imagine paying transaction fees in the token you're sending, not needing ETH separately, or billing in spending limits or requiring multiple approvals for large transactions right into the wallet itself.
And things like embedded wallets or MetaMask snaps.
All part of making self-custody potentially more seamless, more powerful, and maybe even safer by integrating checks or adding new features directly.
Good. Okay, one last thing the sources touched on, stepping back a bit, was just the general risk of crypto investing.
Right. A necessary reminder, wallets are tools, but the assets themselves are volatile. We see huge price swings, Bitcoin crashes, meme coins like Doge or that hawk to a thing popping off and then potentially fading.
And it's still speculative, not backed by governments or physical assets in the traditional sense.
Largely speculative, yes. And the regulatory environment is still evolving. Consumer protections against scams aren't as robust as in traditional finance, though agencies like the SEC and IRS are figuring out how to treat these assets.
But people are still getting involved.
Yeah.
Gen Z adoption, ETFs, making it easier for some.
Yeah, adoption is growing, which just makes understanding these wallet fundamentals even more critical for anyone entering the space.
So boiling it all down from these sources, the core tension seems crystal clear.
It really is that trade-off, isn't it? The sheer convenience of letting someone else manage your keys.
Versus the power, the control, but also the heavy responsibility of managing them yourself, especially with that looming risk of custodial bankruptcy.
That bankruptcy risk is a powerful motivator for self-custody, for sure. Non-custodial wallets are where you find that true digital ownership, that access to DeFi and Web3.
But you have to be ready to be your own bank, your own security expert.
Absolutely. It's a significant burden alongside the benefits. This raises an important question. As the technology evolves, with things like social recovery and account abstraction promising to make self-custody easier, are we actually heading towards a future where everyone can comfortably and safely manage their own keys? Or will the inherent complexities and risks, plus the unpredictable regulatory landscape, mean that true self-custody remains mostly for the tech-savvy or those with a higher appetite for risk?